Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's covered call writing question of the day. Today's question comes from Mike of Escondido, California. Mike writes, I'm a brand new subscriber to the premium service and I'm looking forward to mastering this system. I have a question regarding the stochastic oscillator. In the technical flowchart, it says that you'd like the signal to be uptrending between 20 and 80. My question is, does that eliminate a stock that's above the 80th percentile? Well, Mike, technical analysis is a critical part of the BCI methodology. Let's first start by defining what the stochastic oscillator is. It's a momentum indicator that measures the price of a security relative to the high-low range over a set period of time. That time frame that we use in the BCI methodology is 14 trading days. The indicator itself oscillates between 0 and 100. Now, readings below 20 are considered oversold, and readings above 80, which is what you asked about, are considered overbought. However, I have seen stochastic oscillators remain above the 80th percentile for months at a time, so that does not eliminate a stock from consideration if the stochastic oscillator is above the 80th percentile. Now let's take a look at a chart of what the stochastic oscillator looks like as shown on the screen. The oscillator itself is that thick black line that's pointed out by the black arrow. The trigger is the 3-day simple moving average of the stochastic oscillator. Now all the way to the right of your screen you could see the overbought 80th percentile, which is circled in green and pointed out by the red arrow, and the 20th percentile, which represents oversold. So that's what you're looking at when you're looking at the stochastic oscillator. Now let's take a look at some buy-sell signals related to this particular technical parameter. On the screenshot you see in front of you, we show a sell signal on the left side. It's circled in red. Now a sell signal is when the oscillator drops from above the 80th percentile to below it. And an even more significant sell signal when there's a double dip below the 80th percentile, as you could see on the screen. Now if you take a look above that, you could see that once that signal dipped below the 80th percentile for the second time, there was a very serious price decline in the price of the stock as shown by the red arrow. Now a buy signal is when the oscillator moves from below 20 to above, and a very bullish buy signal is when it happens twice and pops above the 20th percentile twice in a short period of time, as shown on the screen in front of you. If you take a look at the green arrow above that, you could see as soon as that buy signal happened, the price of the stock significantly increased. So a critical point that I want to make here is that the stochastic oscillator should not ever be viewed and made decisions upon in and of itself. It should be used in conjunction with the other technical parameters that we consider, and those are highlighted in detail in my books and DVDs. So Mike, I want to thank you for that question. Technical analysis, as I said, is a very, very important part of the BCI methodology, along with fundamental analysis and incorporating our common sense principles. So it's important to have a thorough understanding in each and every one of the technical parameters we understand. I want to thank you, Mike, and all of our viewers for watching this video. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.